Hey, Steve Saretsky here. As always, the Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask is that you hit thumbs up and subscribe. I appreciate the support. As always, if you have any questions or comments, put those below and we'll banter back and forth. I just want to touch on a few things before I jump into sort of the meat of the video. But the reason why I put these videos out is really just to provide sort of my thoughts, my analysis, to explain them in the video, basically to give back some of the education that I've been able to learn from smart people. And I'm a huge reader, try to read a couple books every month on various topics, and I find this is a platform that I can really share some of those thoughts. I think it's a huge passion for finance. I think it's a very important subject that really doesn't get talked about much in schools, and whether you're talking about real estate or the bond market, whatever, or how money is created and what that means for you or for retirement moving forward. That's something I'm extremely passionate about, and that's really what I try to do behind these videos. So it's always funny when I had a realtor earlier this week pull me aside and saying, "Oh, why are you doing all these media interviews? Like, who are you, and why are you saying the things that you do? You need to dial it back. You need to pull it back." And as if I'm supposed to just fit in this sort of mold, in this box, and you can't say this or you can't say that because you have to sort of follow this this line or whatever. And it's just something I've never been a fan of. I feel like for me, I have to sleep at night, and I have to get these thoughts off my head, and whether that's you feel that might hurt the industry or your business, I'm always going to speak my mind, and I've been very fortunate, like I said, to meet a lot of smart people and to have this data and research analysis, and I think that's why again, everybody formulates their own decisions on what to do with the data, right? I mean, I'll go on a call with the Dominion Securities team on a broadcast call across all of Canada that goes out to all their investors, and I'll provide my insights on the Vancouver market and Canadian real estate, and obviously for those investors that are managing billions of dollars, that's up for them to whether they agree with it or not. I'm always just going to provide unobjective advice to them, and people can interpret that data how they see fit, right? Nobody truly knows what's going to happen with interest rates. Nobody truly knows what's going to happen in the bond market or in real estate prices. I think all we can do is sort of look at the data that we have today. You can do your research, and you basically, at the end of the day, you have to place your chip on the table and make your bet, and figure out what's going to be best for your situation, right? I mean, who knows? Maybe that housing bull market continues, and if that's how you feel, then go ahead, and you have to make that decision, right? It's the same thing, if you feel it's topped out and you want to cash out and go rent, like, that's your decision. And that's really the whole purpose behind these videos, is to provide you with that, really my thoughts, my objective advice, and then or knowledge, and then you can provide you can take that and use it, right? So as we talk about that, one of the things I've been a huge proponent into is discussing from a bigger scale, credit and its role on economic growth and real estate markets. All you can do is look at where we are today. Typically there's a recession every 6 to 8 years, which is called basically the business cycle. We're currently in the second longest expansion. So what we know is we're very late in the cycle. Now, nobody knows when a recession's coming, but we know it's very, very late. And there is one inevitably on the horizon. I mean, obviously, central banks are tightening, increasing interest rates. The Federal Reserve is enacting a quantitative tightening. That's what we know. And to look at the Canadian real estate cycle, obviously households are very indebted. So when you have interest rates rising, that is going to suppress demand. And one of the books I've talked about is Professor Steve Keen. He's very smart on that. House of Debt by Atif Mian and Mir Sufi, I believe. That's a book that the CEO of CMHC references basically in every conversation that he talks about. So you want to get into his head. If you can read that book, and one of the ones that I'm reading now is called Between Debt and the Devil, and that is by Adair Turner. Adair Turner became the chairman of Britain's Financial Services Authority just as the global financial crisis struck in 2008. He has a lot of the same beliefs and philosophies on banking credit. And so what I've said before is basically their whole thesis, all these guys' thesis is the same, is that basically what banks do, and the Bank of England has come out and confirmed this, their central bank there, that what banks do, everybody believes that banks take in your money, your depositor money, they save it, your savings, and they loan it out to businesses. That's how loans are created. But in essence, what banks do is they actually just create new credit at the click of a button, in the form of new mortgage originations or new loans being given out. That's basically creating money. And so banks have the ability to do this basically, to whatever degree that they want. And so what happens in real estate booms is, obviously, as asset prices are rising, they become more confident as well, and they want to lend into it. Prices can only go up, so they feel very confidently in lending. And it's the same thing as real estate prices start to come down. They simultaneously start to pull back, and that really only makes things worse, because banks are almost the same as like an investor, right? When times are good, they're out there lending money. When times are bad, they pull it all back, and that's basically what he argues here. And the financial crisis was basically a buildup of credit. What these banks are doing is they're just lending more and more money from the 60s and 70s onwards. All they've been doing is a trajectory upwards in bank lending. So before, 30 years ago, banks would only lend you 2 to 3 times your annual income. Now they lend up to 7 or 8 times your annual income. And so, of course, naturally, you have higher house prices. And banks like lending against real estate because it's secured land, it's real estate. And that's like the whole philosophy behind it. And basically, I'll try to read a passage here from his book. But to summarize that, he says, by creating credit and money, banks can increase purchasing power, and bank money creation therefore plays a crucial role in stimulating nominal demand growth. So basically, the more credit that you create, the more demand, the more growth that you have, not only in real estate prices, but in the economy. And so what happened in 2008 was you had credit growing, I believe, at like almost 10% a year, and then there's so much leverage, things just basically blew up, and the more leverage that you have, the harder you fall. And so anytime you start to contract credit, it's actually you're basically contracting demand, you're contracting the growth. As soon as you start to scale back credit growth, you're scaling back growth. That's basically the entire premise of the book, which really brings me to what I'm trying to talk about is, now how can we apply that to today's situation? CIBC, as we've seen the stress test, national house prices or national home sales declining, demand started to pull back. Now we're seeing the banks pull back, obviously, with that stress test. CIBC's executive came out earlier this week saying that they expect new mortgage originations to decline by 50% in the last half of 2018. So they're expecting new mortgage originations to decline in half in the last half of this year coming up. So, what does that mean? That probably means that the banks are pulling back. Obviously, the stress test is important, but it also means that there's less demand for mortgages. And so that credit growth is now decelerating, as we've talked about before. Credit growth was growing at its slowest pace since 2001 over the last 3 months. And as you can see here, mortgage credit growth and mortgage originations have been decelerating rather quickly. Again, like I said, that's basically pulling growth out of it. So not only in real estate and the real estate market, but in the actual economic growth. And so that's my philosophy, right? I mean, you can agree with that or you can disagree with it. At the end of the day, that's for people to make their own decisions. As give you an example, I looked at a situation earlier this week with a client of mine that is currently renting. They are looking to, re-rent for another year and then look at the housing market. They feel that the market is quite toppy right now. There's a lot of, they're looking at a detached house. We're seeing prices come off. If you bought at the peak in 2016 for a detached house in Vancouver, you're off about 15% today. That's just the reality of the situation. So they look at that. There's obviously a lot more downwards pressure on the prices. So they want to rent for a year. So there's this house that's been listed on the market in the west side of Vancouver for $4 million. They haven't been able to sell. They've been trying for about a year now at the same price, 4 million, 4 million, 4 million, 4 million, and it's just not moving. And so these guys are obviously been reluctant to cut their price. The selling realtor actually told them, take it off the market, rent it out for 12 months, and then we'll reevaluate where the market is, and obviously try to get you your price. And so my client basically was approached and said, hey, do you want to rent the house? We're going to take it off the market. Do you want to rent it? And I said, well, the house, it's a $4 million house. You can rent it for $4,000 a month. I think, it's a pretty good deal. Rent it for 12 months, see where the market's at, and, we'll go from there. Because I think that the detached market is going to be in a more favorable position for you as a buyer in 12 months. I think there's more downwards pressure as I'm coming. If you agree with that mortgage deceleration thesis, being late in the economic cycle, seeing higher interest rates, banks tightening their loans, and a mortgage, a speculation tax coming here later this year. We have a 30-year low in sales. If you think that bodes well for real estate prices, then you should buy today. But if you think there's that's negative, then I said wait. Rent it out for 12 months and see where the market is. I think it's going to be a better position. So we basically took the opposite sides, right? Here's the seller saying, hey, no, I can't get my price today. I'm going to wait a year. I think the market's going to be in a better position. And I said, great, rent the house, hold out for 12 months. I think you'll be in a better buying position in 12 months. So again, all you can do is take the information that you have and formulate your own conclusions. And so I guess at the end of the day, we'll see in 12 months who's right or wrong and where ultimately the chips fall. And that's basically it. So, I'm not going to ramble on too much about that. There's a lot of good resources that you can check out, whether that's Adair Turner, Professor Steve Keen, the book House of Debt, Dr. Lacey Hunt. Those are a lot of the guys that I researched. Another guy that I follow that is quite smart in the Canadian real estate space, he is coming here June 5th. I'll be attending. It's Ben Rabideau with North Cove Advisors. So he runs an advisory service advising hedge funds, normally in the United States, but in Canada as well. So he's coming here to do a talk on basically the state of the Canadian real estate market, credit flows, etc. June 5th. So I'm going to put a link below if you want tickets to that. Check it out. I will be there. I'd love to obviously meet a lot of you. You can maybe go grab a beer afterwards, that sort of thing. I think it should be a pretty big event. I don't know. I don't know what they charge, but I think it's pretty low entry price. I don't know. I was given a couple free tickets, so I can't give you the price. But all you have to do is go on their website, enter in your information, and they'll get you a ticket. So check that out. Obviously, we would love to see a lot of you on June the 5th here in Vancouver. With Ben Rabideau of North Cove Advisors. Anyways, hope that helped, and I'll see you next week.